Hi, this is Dan Kerr's DK Analytics. It is February 26, 2019. I'd like to discuss here in video format the following: an out of the closet Fed monetization confession. Before I do that, some brief valuation metrics. Trade weighted US dollar is still hanging tough despite the Fed confession at 91.42. Intraday on 2/26/19. 10-year is close to 2.7%. The yield inching back up a bit. S&P 500 27.98, closing in on all-time highs. Oil 55.41 per blue barrel, inching back up with a mild correction currently ongoing. Gold today on the 26th of February, intraday 13.26 per troy ounce, and silver at 15.86. Now, as you're probably all well aware, last week the Federal Open Market Committee, or the FOMC, minutes were released. That meeting took place on January 29th through the 30th and was released 6 days ago on February 20th. And I want to go over some of the highlights there, my own take, the implications of it, and also just yesterday news came out, yesterday there was a further Fed Chairman Powell, in essence, doubling down on the committee minutes at the end of January, where the headline that tallied or correlated to this story is Fed to reconsider balance sheet plan after market swoon. So what current Fed Chairman Powell is doing is, in essence, is confirming the minutes from January 29th to 30th in terms of the Fed's stance, which is moving strongly in the direction of dovish from hawkish. What are the big takeaways from the FOMC meeting, the 2-day meeting, January 29th through 30th? One, there was a widespread agreement among the participants, the FOMC participants or board members, to end shrinkage of the $4 trillion Federal Reserve Board balance sheet, Federal Reserve Bank balance sheet, I'm sorry, that is all the reserve banks together, by the end of 2019, by the end of this year, combined, get this, combined with a readiness to revisit bond purchases / balance sheet expansion, also known as QE, as necessary in the future, as the Fed chairman alluded to yesterday, once again, at his U.S. Senate testimony. Recall, if you will, that it took 100 years, over 100 years actually, for the Fed's balance sheet to reach $900 billion in 2008, prior to it ballooning to nearly $4.5 trillion in the years after the financial panic of 08-09. A level, by the way, which it held until about 14 months ago, when QT, quantitative tightening, bond sales got going and reached a level of 50 billion a month, or 600 billion per annum. In addition, the FOMC essentially indicated that it is tossing the hawkish December forecast for 2 additional rate hikes, already a climb down of earlier expectations, out the window for this year. Plus, the committee said it is monitoring, get this, increasing downside risks, notably slowing global growth, recent turmoil in financial markets Q4 of 18, and trade tariff uncertainty. The translation: The 14% Q4 18 stock market correction, which was almost 19 or 20%, save for the if it weren't for the rally in the closing week of the year, that correction scared the crap out of the bubble blowing Fed, and I might add other central banks as well. Last but not least, the FOMC indicated that the Fed was becoming more dovish in its view on inflation, despite signs of percolating inflation in the much larger service sector of the economy. You know, little quote unquote things such as tuition, medical services, insurance premiums, water and sewage and trash collection, etc., which are all increasing 2-3 times or more in the CPI, bogus tally that the government tries to hoodwink us with. At any rate, clearly another rationale, however ill-founded or less than honest, for not raising rates, the federal funds rate, further. Let me now add some thoughts and interpretations to the FOMC, Federal Open Market Committee minutes, and Powell's congressional remarks just the other day. A central bank that electronically prints the money to purchase debt and admits that it cannot shrink its balance sheet down to pre-QE 2008 size, or even remotely close to that level, almost 900 billion, has de facto admitted to permanent monetization. That is, it has admitted to buying bonds with counterfeit money out of thin air, no sweating behind it, no blood or sweat, no toil. And it also has let investors know, by extension, that this currency debasement will be part and parcel of the Fed's monetary policy, given remarks made about revisiting quantitative easing as potentially even a permanent part of the Fed's, quote, toolkit, unquote. Wow. Translation: if stocks or bonds come under enough pressure, the Fed's electronic printing press will shift back into high gear as the Fed funds rate, the short-term rate that the Fed controls directly, plummets back to zero. I would observe that you cannot nurse an economy back to health that labors under a toxic public policy stew consisting of regulatory and litigation insanity, and ever-growing redistributionism, and third world amnesty welfare. All right. Regulatory insanity, how about over $2 trillion in regulatory compliance costs and rising as a percent of GDP? That's 10% of GDP. How about corporate America's legal costs as a percent of top line being more than 2.5 times Europe's? How about ever-growing redistributionism defined by roughly 50% of Americans of tax-paying age not paying federal income taxes and a similar amount receiving government welfare, federal government welfare? How about on the third world amnesty welfare front, hundreds of billions of dollars spent each year on top of an American job loss spiral and pressure on wage levels that I delved into in my prior video and extensively in post number 10. Our public policy stew in the US and in the West at large, and OECD nations at large, requires currency debasement. That is, currency printed out of thin air to avoid a financial, economic, and political collapse. That's the reason this can't stop. This stew this toxic public policy stew does what? It rescues debtors, punishes savers with yield deprivation, and transfers property from Main Street makers to cronies, to takers, and to third world amnesty recipients. Along the way, discouraging savings and capital formation while encouraging yet more debt, the progeny of the printing press. You cannot create solid, good paying jobs in a big way in such an environment. Even less so if you are focusing on raising tariffs, arguably the most destructive form of cronyism on essential materials such as steel and aluminum, which makes or threatens to make broad swaths of your manufacturing sector either less competitive or uncompetitive, while potentially triggering a trade war. We know what a disaster that is for the global economy if it happens, in place of addressing the real elephants in the room. Those elephants, as I've often stated, are comprised of domestic impediments to capital formation, punitive regulatory and litigation/legal costs, and lacking strategic parallel interests between America's C-suites and the other corporate constituencies. C-suite execs get extremely lavishly compensated for, in effect, pursuing corporate anorexia and de facto LBOs, leveraged buyouts, while remaining a public stub, a public residual in the public stock market. They do this over winning in the marketplace. That is, the C-suite execs get compensated for pursuing corporate anorexia and LBOs over winning in the marketplace with sustainably competitive goods. The proof of the pudding? An expanding $653 billion net trade deficit annually. What am I talking about when I talk about de facto LBOs? How about this? Take a look at this. This is on a quarterly basis over 2 decades. Some $8 trillion in buybacks, funds that could have been used to push organic growth, expand P&L, spend R&D dollars, expand the payroll, and come up with much more competitive, newer product portfolio competitiveness. But alas, it's not there. And this is also as a result of our financial repression, which finances the what I continue to refer to as the toxic public policy stew, which is sand in the gears of free market capitalism and the wealth of nations and maximum prosperity and choice for the widest amount of people. Moreover, that same toxic public policy stew, comprised again of regulatory tax insanity, a lot of redistributionism, growing and growing, massive third world amnesty, all these things that are enabled by the electronic printing press, despite a claimed 4% unemployment rate, has contributed to, right, student loans in the $1 trillion plus column with skyrocketing default rates and about a third of millennials living in their parents' basements. Call it, if you will, a double whammy of extremely expensive, taxpayer financed, and massive student loan enabled leftist professors ensconced in ever more lavish campuses, juxtaposed against mostly worthless degrees issued by colleges that don't give graduates traction in a poor job market. This is also why we have trillion-dollar plus car loans with rapidly rising default rates. In the vernacular, people's incomes aren't keeping up with costs or desires. No strong economy here for Main Street. This is also why, again, despite an alleged 4% unemployment rate, which would be well north of 20% if unemployment was tallied in the manner it was prior to Clinton's second election, where the long-term discouraged were on board in terms of the labor pool looking for work. This is why, despite this alleged 4% unemployment rate, we have private sector debt at record levels, over 13.5 trillion. Yet home ownership levels, a huge portion of historical debt and debt growth, are near a two-decade low. This is also why the U.S. is $71 trillion in debt at all levels, government, corporate, household, right? Up a whopping $3 trillion in just 1 year. In just 1 year, the U.S. at all levels has added another $3 trillion in debt, which amounts to 3.4 times the most recent GDP tally. And this during a period of claimed real economic growth, inflation-adjusted economic growth. I've often said, remarked, if we had a true inflation tally, we would have negative real growth, but let's not revisit that at this point. In this light, consider in the 71 trillion in debt, right, at all levels, consider that just a 1 percentage point higher average cost of borrowing will cost the U.S. economy $700 billion more in interest expense, an economy of roughly 20 trillion, or 3.5% of GDP. And this within a few short years, just 1% higher average borrowing cost. In a few short years, given a focus on short-term financing and the related frequent refinancing needs. That's a lot of headwind, right? If, by extension, we reached a historical mean borrowing cost level, keyed off, let's say, a roughly 4.5% benchmark interest rate or 10-year treasury yield, America's cost of funding, prior to adding another 2 to 3 trillion a year in new debt, would surge by approximately 1.4 trillion per annum within a few short years, given the emphasis on short-term financing. This then would be the equivalent of 7% of GDP. For some historical perspective, in the much less leveraged age of the 80s, government debt, early 80s, stood at around 33% versus 105% of GDP government debt today. And also in the much less misallocated 80s, right? Not only much lower debt levels to GDP in absolute terms, but also much less misallocated early 80s. That means that cheap money didn't lead to as much bad lending and as much bad investments as is the case today. The benchmark interest rate in 81 hit 15% plus. We're under 3% today. Hello? In a nutshell, until America revisits material constitutional fidelity, very much including sound property right protections, regulatory and litigation sanity, incentives to save, and sound money that requires participants, companies, the S&P 500 variety, to win in the goods marketplace instead of via financial engineering / stock buybacks. Again, some $8 trillion worth in less than 20 years that could have been put to work in improving organic growth and product competitiveness. Until that happens, right, we're going to, that is the economy, the powers that be, the vested interests, the owners, will insist on more and more financial cocaine to stay the unsustainable course as long as possible. That is, until creditors demand compensation, adequate compensation, for towering insolvency and monetary inflation risks that are getting larger by the day, right? I mean, when you're increasing overall debt by 3 trillion and government debt by north of 1.3 or 1.4 trillion prior to a recession, it's and add that to 22 trillion in operations debt of just the federal government, and many states being bankrupt and unable to meet the pension payouts that they have guaranteed. You're looking at tremendous pressure to print, because it's the politically least disruptive in the near term, but has tremendous negative implications, as we know, in the long run. Well, when creditors finally get to the point of demanding adequate compensation, that is, risk premiums dialed in on top of 10-year treasuries, which themselves would be under substantial pressure to arc higher, as I mentioned, at such a juncture, the creditors, with some 250 trillion in global debt, or 3 times global GDP outstanding, they will overwhelm puny central bankers and their ability to purchase assets, and as a result will deeply punish currencies of financially irresponsible countries, as has always happened. Call it bond vigilantes revisited. In other words, until creditors bolt, or until the US and the OECD world at large re-embraces free market capitalism and freedom over financial repression enabled misallocations, redistributionism, third world amnesty, and pervasive cronyism, there will be no way to avoid ZERP and money printing, or yet more financial cocaine to bail out debtors at the expense of creditors, to bail out cronies at like TARP and everything else, or bail-ins and bailouts in place of Main Street creditors. In the late January FOMC minutes, the Fed finally admitted to just that, even if it wasn't open and honest as to why, which it obviously never is. Let's not forget, the Fed comprises of its member banks. It's a cartel with a monopoly on determining what is money. Constitutionally, it should be gold and silver. So they're going to obviously feather their own nest and not tell us the truth. But that's beside the point. Specifically, given our large toxic public policy stew, long established, very entrenched over decades, in our hugely leveraged economy featuring gaping and expanding funding / financing needs, the Fed obviously can't continue to shrink its balance sheet, nor raise rates towards real rates for the benefit of savers and investors on the one hand, and to reduce poor ROI misallocations on the other hand. That is, bets made on returns on investment that would never have been entertained were the cost of funding real, reflect the real risk being entertained and a risk premium that creditors would demand, which has been pushed aside, obviously, by financial repression. But we cannot, the Fed cannot allow this thing to come apart at the seams, because if the Fed continued to throw bonds into the market, QT, instead of buy them, and thus suppress the true cost of capital, if we didn't have an artificially low cost of capital, in other words, our fiscal, monetary, and political insanity, including massive redistributionism and third world animosity, would have not been able to hide without triggering an economic meltdown. Our fiscal and monetary and political insanity would have long ago been overwhelmed by economics 101. Right? Therefore, the Fed has had to admit that broad daylight monetization or currency debasement, with more in the pipeline, is the only politically palatable recipe. It's also the recipe that is in the interest of its cartel member banks. This cabal is at the end of the day interested in furthering its own destiny. The hell with everything else. When contemplating this, please recall that inflation, which is a monetary phenomenon at the end of the day, you can't keep increasing the monetary base forever, even in a fractional reserve banking system, without at some point dramatically increasing the money supply, right? The money multiplier doesn't go down forever. We'll get to the crack up boom in a second. But inflation really is a sneaky default, near term, midterm. That is until the vertical part of the J curve, vertical, kicks in. I'd argue that collectively speaking, we are junkies that require our fix, our cocaine, financial cocaine fix, because the votes aren't there. Too many indoctrinated takers, right? Takers vote much larger numbers than makers or owners and entrepreneurs, because there's a lot less of those. And takers no longer understand that it's in their own best interest to cheer on the true value creators, because they're the ones that provide the jobs for everybody else. But you cannot reinitiate tough love, fiscal, economic, and political sanity, constitutional fidelity in such an environment, right? The very attributes, the very policy, the very constitution that gave us the productivity and wealth we are now recklessly dissipating. And the Fed is acknowledging that that's going to continue, because politically that's all that's viable. Welcome to kindergarten without adult supervision. Welcome to Frankenstein finance sustained. What's the takeaway in all this? What does this Fed confession of broad daylight monetization and Powell's follow-up remarks mean for both solvency and inflation risks? Well, I think it means the message that he tells and the Fed tells could not be more profound nor more threatening. Financial insolvency, our current state of affairs, will continue to be addressed with ever more counterfeit currency, which will beget ever more debt while it trounces creditors and consumers' purchasing power. How does one spell monetary disenfranchisement, also known as property theft? Therefore, instead of trying to address our profligate public sector spending, our debt mountains, our towering and widening deficits, and our toxic public policy stew, we will, quote, paper them over, unquote, as the only politically expedient solution. You know, you never cure profligate spending with more spending, right? That's in essence the takeaway. Meaning we will print the money to pay the unpayable. It's called debt monetization, plain and simple. And the Fed has come fully out of the closet with it, no matter what Ben Bernanke said 6, 7 years ago that would be the case. And Powell just doubled down on it yesterday in front of the Senate. Yet the market is still asleep at the switch in terms of pricing this in, which is a huge, and I admit, continuing reallocation opportunity. Sustained monetization will do nothing other than guarantee even bigger deficits, because they can be financed near term, and even more debt because the elephant in the room, our toxic public policy stew, as financed by financial repression, doesn't need to be addressed yet, but that yet is shorter and shorter. It also guarantees, of course, more misallocations and progressively lower productivity, lower growth, higher debt, and ultimately higher inflation, which is nothing other than a piecemeal insolvency until it hits the vertical part of the J curve, or a crack-a-boom in Austrian economic terms, which is a flight into tangible assets. First, creditors' purchasing power gets bled away slowly, and then it speeds up, and then it just gets crushed, bringing about the equivalence of insolvency. We are at that precipice, given the admittance by the Fed of what it will do when financial markets unravel next. Too many dollars will be chasing too few services and goods, Econ 101 stuff. Again, you cannot forever balloon the balance sheet of central banks without impacting the money supply. Else, why would the central banks do it in the name of creating demand or growth, right? This will be especially true with growing creditor rejection of the US dollar and US dollar assets in view of over $8 trillion in net US dollar assets held by the rest of the world, and thanks to annual US financing needs of some $600 billion by the rest of the world. Those dollars coming home will stoke domestic inflation, meaning people sell them and buy oil, or they buy agriculture, or they buy agricultural land, or they buy more inventory of raw material stock-ups, what have you. When investors flee overvalued treasuries, they will inevitably seek shelter in, as I mentioned, scarce, vital, real assets that can't be printed. History shows it's from energy to agriculture. And it shows it over and over. And this is, if this sounds far removed, think of what's happening in agricultural rich and oil rich Venezuela. Hyperinflation. And think of food prices and energy prices through the roof in their fiat currency. A shift out of rapidly depreciating fiat money, in this case the buck, into real assets will, in addition, give inflation a further boost, including at your Walmarts and your local gas station. Call it services inflation plus. In addition, a secular shift from corporate inventory management away from just-in-time inventory practices and super high inventory turns to purchasing, and even hoarding select raw materials and the related components prior to those getting more expensive will fuel even more commodity demand, driving up prices further still, especially after decades of, as I mentioned, trying to reduce inventory to drive asset turnover and ROE higher. I addressed this in my video on ROE called Cyclical and Secular Pressure on ROE. Thus, with the dollar likely to decline on the back of global realization that there is no will to get back to fiscal sanity in Washington, D.C. whatsoever, on the back of a spreading realization that rising U.S. interest rates at the short end have been truncated and will decline prior to even reaching a small real rate of return, a real world real rate of return, not using a real inflation rate is what I'm trying to say. And with the rest of the world holding vast amounts of dollars and the bankrupt U.S. government requiring ever more financing, the gap between receipts and spending, we could see the dollar fall out of bed at any time, while domestic creditors/investors may well also get cold feet on the outsized Treasury financing front, where they've stepped up purchases as the Chinese or the rest of the world has decreased their purchases. That might not continue. Why? Because they could get cold feet about this relative supply-demand imbalance, too much paper being thrown on the market, requiring a higher yield or a lower price. Remember, a fine cigar turns into a stinky stogie virtually overnight. People are fickle. And an emperor with no clothes. Well, all of a sudden, everyone sees him in his underwear. As regards the naked dollar, a rush to sell dollar assets will be underway just as the supply of dollar offerings via dramatically heightened financing needs continues to mushroom. What I'm trying to say is that this will likely feed on itself, snowball, to yield a suddenly deeper and more rapid decline in the buck, which would pull bonds and stocks down with it. Because what do people do with dollars? They buy bonds and stocks, right? Real estate. This would happen as investors, both domestic and foreign, flee overvalued long duration U.S. assets, such as 10-year bonds and blue chip stocks. Such a development, when it occurs, and I think it's around the corner this year, this quarter, soon, such a development will force the Fed and other counterfeiting central bankers, they all are, no one is tethered to gold and silver anymore, it would force these counterfeiting central bankers into unparalleled asset purchases as they will fight to sustain their ill-conceived bond and stock bubble prodigy, which they believe is the wealth effect gift that keeps on giving, despite profound and sustained evidence to the contrary, as in poor real economic growth, poor productivity, ever greater leverage, and a rapidly growing wealth gap that has reached an unprecedented scale in numerous OECD nations, very much including, if not led by, the United States. QE on steroids, what I think is in the cards and in the near future, not in the distant future, will benefit central banks, crony pals, their member banks, Wall Street, and K Street, the people that move, the cronies that move in and out of government in what has become the United States of Goldman Sachs. Just look at Trump's cabinet, which features 6 or 7 Goldman Sachs alums. This trend has also engulfed, obviously, London, Zurich, Frankfurt, and Tokyo. More cocaine wealth for Wall Street and K Street is lousy for Main Street and Main Street makers and even in Main Street investors and retirees. Yield starvation. Call QE on steroids in our future kindling for even more widespread socialist destruction in the making. Think universal income. Think free college. Think Medicare for all. Think family leave. Think wealth taxes. Think progressive income taxes arcing to 90%. This is the legacy which our cronyism has produced, this disparate situation between the very top, which have largely, to a disconcerting degree, benefited not primarily from building better widgets, but from financial engineering and being close to the center of where it starts in Washington, D.C. and in Wall Street. Well, if these socialist destructive ideas become law or regulations on top of the widespread redistributionism and third world amnesty that we already have to contend with, on top of the regulatory insanity and the litigation insanity, if this happens, our output leverage and economy dependent upon productivity being sustained and growing, it will wilt, especially if progressive income taxes arcing to 90% are combined with a withering green-red energy insanity policy, if that in fact becomes law. All of this will be under the guise of taxing the rich while not touching the average person. Typically destructive, despotic, Marxist claptrap, which we have to deal with given the abuses of cronyism and unsound money. 2020 socialist election writ large, anyone? I'm afraid that's what's going to happen. Meanwhile, private investors, as well as bankrolling nations, will inevitably sell and remain uncommitted to repurchasing portfolio assets prior to substantially higher risk compensation. When will they sell? When the first shoe drops. When we've got the first chapter of widespread carnage. They will wake up, they will sell, and they will stay out for quite some time, waiting for the second, the third, the fourth shoe to drop, which will mean much higher bond yields and much lower stock PEs or higher stock earnings yields are in the cards. Remember, we never have reversion to the mean in anything, especially not in markets. We have reversion beyond the mean. We have a manic depressive Mr. Market, which has been aggravated by financial repression, right? The removal of price determination by private investors. This will occur, I'm going to bet, simultaneously with a sudden recognition, a belated dawning, thanks to a new layman moment, of towering and rising illiquidity and insolvency risks, leading to hugely heightened monetary inflation risks, unprecedented QE, and broad daylight theft risks. Call it a repricing of risk beyond the mean. Call it a reset where walk will likely precede talk, as is always the case. Simultaneously, our misallocated economies, featuring an ever older OECD population, combined with an overdue recession, will result in unequaled borrowing needs, driving yields up higher still. If supply exceeds demand in anything, the price has to drop. That is, bond prices have to fall and bond yields have to rise. The perfect revaluation storm for bonds and stocks after a nearly 40-year bull market in bonds, before a downshift in earnings power, given all our headwinds that I've mentioned. And while the central bankers will increase their financial cocaine, they will no longer be able to avoid an overdose, meaning the financial and economic patient won't respond or respond as quickly and will require unheralded intervention, QE, or ZIRP, or negative interest rate policies. That same intervention will end up killing the totally unwarranted confidence, I'd say it's ignorance, in monetary Keynesianism. It goes against human nature, right? It just does. You can't just create wealth by printing money. You can't take away incentives to save and to produce without killing productivity and output and creating the opposite of the wealth of nations. It's just human nature, right? In any event, this will unleash what will likely be a secular period of stagflation like we've never seen, meaning even weaker real growth and higher inflation rates than during the stagflationary 70s into the early 80s. What this means for bond and stock valuations could not be more profound and foreboding, in my opinion. In plain English, look for a return to single-digit PEs and double-digit investment-grade bond yields sooner rather than later. I'd speculate within a few years, possibly earlier. And I'd say return to on purpose. Once again, consider that in the early 80s, with a fraction of the debt and a Fed balance sheet in 81 of under 200 billion, not 4 trillion, the bond bear market pulled treasuries down to 15% plus yield, and the S&P 500 stocks to a 14% earnings yield and a PE of under 7. As such, consider reducing exposure to the US dollar, to overvalued bonds and stocks throughout OECD countries, but especially in negative free cash flow America. As the rest of the world realizes the US is totally bankrupt and ready to print creditors' purchasing power into monetization oblivion. Once this recognition is priced in, nominal return prospects from bonds and stocks will have to be much, much higher, crushing current bond and stock valuations before compressed earnings power even hits, which will then likely make for great, perhaps once-in-a-lifetime strategic purchase opportunities. Stocks trading for 6-7 times earnings, bonds yielding double digits. Speaking of opportunities, take today's opportunity, the gift of a bear market stock rally that has brought the S&P 500 to within 5% of all-time highs thanks to the reimposition of the Fed financial cocaine put. Take this opportunity to go into short duration / non-interest rate sensitive cash, such as T-bills. In addition, take this opportunity to either purchase or add to your physical precious metals holdings, which will preserve your purchasing power over time. Simultaneously, and as often mentioned, consider how dramatically undervalued purchasing precious metals today is. I could make a strong case for $10,000 gold per troy ounce and over $200 silver based on today's central bank balance sheets, global balance sheets, and on global debt numbers. Precious metals look like a long suppressed coiled spring, ready to spring much higher even before an even greater currency debasement round begins. Call it purchasing power protection plus, call it cash on steroids. Ironically, and as stated in both posts and videos numerous times, the Fed's embryonic QT, sales of bonds, or balance sheet shrinkage, coupled with its historically underwhelming Fed funds rate rise, will kill a misallocated, debt-laced, declining productivity economy, which will usher in an even faster return to full-blown Frankenstein finance / financial cocaine. This is what I wrote about last summer. This QT will speed up the rate, excuse me, at which the Fed has to revert to form, all right, to all kinds of dovishness and currency debasement. This fact, this realization cannot be lost on creditors and shareholders for long, especially not when we recall that bond and stock valuations are historically tied at the hip. This great chart, courtesy of Yardini, shows it very nicely. I hope I'm getting this. And here you're going to 14, 15% yield, the red line on over 15% yield on 10-year treasuries, and you're reaching an earnings yield, the blue line, on S&P 500 stocks of roughly the same amount, 14 to 15%. And this then was the best purchase opportunity for decades of what? Of falling bond yields from a very high level, from a very high level, and falling earnings yields also from a high level. An earnings yield of about 14, this blue line here, all right, is a PE of 6.7. So my point is bonds and stocks travel together. Why? Because they're discounting mechanisms. And the discounting mechanism is based upon, historically, a 10-year treasury plus a risk premium, which we've stripped largely or reduced over time, thanks to people believing that stocks aren't as risky, but which will widen with all the financial leverage and the bankruptcies to come, right? So we're going to have plenty of great opportunities, but not down here, right? When we get back up here. And I believe we're going to revisit the late 70s, early 80s once again. All right, look at this spike. And remember the long bear market in stocks from 67 till 82. We've got much less headwind this time around than I would argue we had in 82, from a host of perspectives, from debt to property right protections, to misallocations, to much reduced productivity. It was easier to dig out of that hole then. It's going to be harder this time. So why should valuations, PEs or yields, be any less attractive in the future than they were in a less troubled past? That's the point. And by the way, in keeping with that, neither the law of physics nor the law of economics has been repealed. And politics, as we know, can only dominate the law of economics on an interim basis. After a decade of unparalleled monetary Keynesianism, go figure. Meanwhile, the tiny gold market and the puny silver market combined approximately 0.5% of global investable assets, mostly bonds, to a lesser degree stocks, to an even lesser degree REITs. They comprise roughly 300 trillion today in total market value. And you're looking at tiny gold and the invisible silver trading at less than 0.5% of that amount. They've historically gone up to 1.5 or 2 or even 3% once in a while. We just need a little move towards these small reallocation, and we're off to the races. Why? Because there's a dearth of silver and gold supply. Remember, only about 13, 14 billion of silver is mined a year, and most of it above ground is in junkyards or expensive to get at. In other words, on the PM allocation front, when it happens, it will only be possible given the small mining and the small above ground supplies heaped on top of the tiny allocation and a small amount in addition that people will be able to get. Just going from 0.5% to 1% would take mining of 5 to 10 years, right? You will be able to only realize a higher precious metals allocation in your accounts, not by purchasing tons of it because they're scarce, but by seeing a much higher equilibrium price. That's the point. So those that have it, that have bought it prior to it being requested or demanded in much greater amounts than is currently the case, they will have it and they will enjoy the higher equilibrium price that will boost the remaining world's allocation. That is the opportunity. I hope you found this of interest, and thanks a lot for tuning in. This is Dan Kerr's DK Analytics. It is February 26th, 2019. Bye-bye.